Hello, everyone, and welcome to another episode of the IA Talks AI. My name's James King, and I'm delighted to be your host. Now, in today's episode, we are going to be exploring the very topical and very lively debate around whether or not there is currently an AI bubble. We're going to be looking at the case both for and against, as well as exploring the potential implications of a bubble, should there be one, popping at some point in the near future. Now, to guide us through this topic, we're very lucky to be joined by Rachel Baxter, co-head of US Bond Index at Vanguard. Rachel, thank you for joining us.
Thank you for having me.
Now, Rachel, we're recording this podcast in early November, and for the last couple of weeks, all the talk of town has been, is there an AI bubble? And we've seen many warnings from the likes of the Bank of England, the IMF, bank CEOs, and many others. So why is it that so many people are concerned that there could be an AI bubble at the moment?
Yeah, I think what is happening is, look, like the tech sector is very highly valued. There's no question about that. I think particularly in the US, you would say that the valuations are looking stretched. Some of this is driven by an element of FOMO, so people fear of missing out on these positive returns, and there's a lot of AI hype around, and so that's probably also potentially going to drive even further upside from here, just from the FOMO element. And I think what we would say is that the AI upside is in all likelihood priced in, but really the extent of the positive outcome is actually very uncertain. And so when that is the case, when something is priced in, but it's actually an uncertain outlook, the greater likelihood is that the tech is actually overvalued. So I think from a sector standpoint, yes, technology itself is looking overvalued and stretched. But actually, the broader market is a bit more interesting because I think if you do believe in the hype around AI and the fact that it is going to be transformational, which I know I certainly do and Vanguard does, then actually the broader market stands to benefit from that. You're going to have productivity and growth coming through, impacting all areas of the economy. So while there is a lot of bubble talk and valuations being high in the tech side, I actually think the broader market is very interesting at this point because there it's less so priced in, and that is going to benefit overall too.
So what evidence is there for there being a bubble?
Yeah, so I think there's definitely arguments for there being a bubble right now. I mean, like I've already said, it's unclear actually how technology is going to be able to, these technology companies are going to be able to monetize AI. So right now, like I said, there's a lot of upside being priced in, and we're not really sure how they're actually going to monetize that in the end. The other aspect actually is that investors right now are very blind to what that future growth and productivity could potentially look like. And there was that MIT study recently, which has been very well publicized, which showed that actually, like a lot of companies haven't started realizing the bottom line yet of what this could be. And so you might find that investors start to demand more tangible results to be able to continue to allocate capital to this sector like that. But I think the most clear argument for a bubble I hear a lot is around the circular deals that are in place. So the most famous one is the NVIDIA and OpenAI, where I think NVIDIA has agreed to invest in OpenAI in return for them purchasing chips from NVIDIA. And OpenAI has also had an announcement this week for being tied into deals with Amazon, and they're really doing the rounds and tying themselves up with all these different companies. And I think that's where some people have had some similarities with .com, but really what this is built on is that these companies are trying to find the compute power, find the chips and the access, and it's about getting that access to the capacity and the infrastructure needs that are going to be there. But I think that's probably one of the more compelling arguments for a bubble.
I could just ask a quick follow-up question on the circular deals issue. Could you just explain for everybody listening, why are these circular deals, or some people might describe them as vendor financing, why can these type of arrangements be problematic?
Yeah, so the issue you have when you have these circular arrangements is that if one company ends up struggling, does it take down the other companies that are in those arrangements? And I think OpenAI is not profitable yet. It isn't as sound fundamentally as like the Magnificent Seven. It's a newer company. It's still on a very rapid growth trajectory. And so you do have that concern if they were to be unable to fulfill their contracts, does it bring down the other companies? But this actually then ties into why I personally don't think we are in a bubble, like these arguments. And it really comes down to the fact that these tech companies, the Magnificent Seven specifically, where a lot of these valuations are focused, they have incredibly strong fundamentals. So they have real strong profits, they have double digit revenue growth, they have high free cash flows. And there's a lot of factors out there that actually justify their valuation. So you've got just the innovation that they have, the productivity, favorable regulation right now with the administration. They have strong balance sheets, and also their earnings expectations are incredibly strong right now. And actually, if you look on a forward-looking basis, they're not actually overvalued because that earnings trajectory is unprecedented. And I know there's some arguments of, well, maybe that's too high, but it is based on a real backlog of demand. And there are concerns around the capital expenditure that's going on, particularly like built center build outs have been the recent one. But these aren't speculative right now. There is a real capacity. There is a real demand for this capacity through the backlogs that are already there. So I don't even think we are at peak investment yet. Really, these CapEx projections are probably going to continue to increase throughout 26 and 27. The other thing that really, in my mind, shows that we're not in a bubble is the market is actually setting a high bar for these companies. So they are really scrutinizing the result and particularly the CapEx plans. And you saw that with Meta's stock performance down around 10% on their results last year. And that was because there was a lot of skepticism put in to the fact that they have these high CapEx plans without any clear idea of kind of what the end outcome is going to be from a profit standpoint. So that to me is not, we are not as a market rewarding losers or unviable companies. We are being very careful and we are setting that high bar. But that is to say, yes, I don't think we're in a bubble, but there's no doubt that valuations are high and we're placing a very big bet right now on what is an uncertain future and potential. And that means that you're going to have greater downside risk, which might actually outweigh the upside potential currently in this sector. And while we're not in a bubble, I do see some catalysts for some pullback in valuations right now. So there has been a wave of recent debt issuance, both on and off balance from both on and off balance sheet from these companies, and I would expect more to come just around these capex expenditures that they have. And you're probably going to see that starting to weigh on equity valuations. I think that's some of what the recent weakness yesterday in the markets has been driven by as well. We have already seen credit spreads widening in these big tech companies that are coming with supply, and that's because of this expectation of more supply to come. And the other thing that doesn't really get so much airtime is that we do have real bottlenecks and constraints on resources here. So the physical resources, the data centers that are needed, but the power generation that's needed, the water supply that's going to be needed for cooling and things like that, that's not really priced into the equity market. Now, you could argue that that's because these companies are innovative, they're creative, they're going to find ways to find solutions. And I think that is a fair argument to make. But like I said at the very beginning, this market in technology sector specifically is priced for perfection. And it's not taking account of some of those constraints that we need to figure out how we get around.
Well, thank you. It's so valuable to have your perspective on all of this. If I could ask you a question now just about the nature of bubbles quickly. So are bubbles only ever bad, or can they actually have some benefits too? Of course, besides the obvious downside of when they might burst.
Yeah, so that's a very interesting and very good question because actually bubbles do spur innovation and investment. And I think what is happening now with the valuations going higher and higher and the hype around AI is that it's bringing this investment in the capacity and the infrastructure that is required for AI. So things like the compute power that we're going to need, the chip supply, the data centers, all of that is necessary. And technological transformation really does require heavy capital investment. And I don't think you would be getting that without the hype around this sector currently. And what that is going to enable is it's going to enable increased growth and productivity across the entire economy, not just for this sector alone. And I know there are some concerns around, well, are we overbuilding? Is there spare capacity? But really, I don't have concerns about that. Even if this does end up being a bubble and it does burst and we do have spare capacity, all that's going to do is lower the cost of access for the rest of the economy and the rest of the companies. And in my mind, that's a good thing because AI is going to transform the way we operate in the way that electricity did in the past and the internet did in the more recent history as well. So lowering that cost of access for all is going to be beneficial for the economy.
That's great. I suppose one sort of concern specific to the investment in AI infrastructure that I've heard about is the fact that a lot of these chips probably have very or a relatively short shelf life of, I've heard, between 3 and 5 years, and therefore, lots of investment could go into buying them, putting them in data centers. And should that capacity not find a home in the reasonably short term, those chips kind of would go out of date. And unlike other types of investment, which have a longer shelf life and could end up being useful further down the line, that could be a bit of a problem. What do you say to that concern?
Yeah, I think that is a very valid concern. And obviously, a depreciation rate should reflect that, which should come through in the earnings as well. And so I don't dispute that concern at all. That's definitely something that is, again, like higher on my radar in terms of things that could trigger a bit of a correction in the valuations here. And that doesn't take away from the overall beneficial outcome of AI in the longer term. But we do need to be mindful that because there is so much unknown right now and so much uncertainty, things like that may not be being appropriately priced in. And I would definitely value that consideration.
Cool. Okay, so let's say, for the sake of argument, there is a bubble and it's going to go pop at some point. What do you think would be the potential impact of a big market correction? And how should investors be thinking about this in the context of their portfolios?
Yeah. And so I think if you get a situation where you have a huge revaluation of these equities in the sector, let's call it a bubble burst, but even just a meaningful, like say 20% correction, would be a lot for the market to absorb. And I think in that situation, you're going to see all markets down initially. So that's going to be all regions, that's going to be all sectors. But I think that would actually introduce an interesting buying point because, as I've mentioned previously, the fact is that AI is going to be transformational across a broader spectrum of the economy than just for technology companies. And so even though we might get that strong revaluation, that strong market movement, you're going to have companies that actually will what didn't have the AI benefit priced in yet that still stand to do well from it. And I think those become a lot more interesting in the case where you have a broad market sell-off, which feeds into like a diversification argument. So I would say a sell-off in my mind in the equity market is really probably a buying opportunity, particularly for those companies that are probably going to gain market share as a result of it, but also the broader market that will also sell off alongside the tech companies that maybe fundamentally don't have as much reason to sell off. I think what's going to be really interesting from a market perspective is what happens to the technology companies themselves, because you obviously have the Magnificent Seven, very large, established, very strong fundamentals, as we already outlined. But then you also have the startups, the ones that aren't profitable yet, the very, very large startups like OpenAI that but still are not at profitability. And so you could have a cleansing impact where some of the smaller unviable companies disappear. And you will find that the larger companies with the sound fundamentals, the strong business models, could actually expand their market share even further. Because if you think of the dot-com era, I think Amazon fell more than 90% at that point. And now look at Amazon now. Like it cleared out a lot of the smaller companies, the ones that weren't going to survive. Yes, Amazon took a large hit itself, but if you stayed invested in Amazon, you'd be laughing right now. You'd be loving your portfolio. The reason I do think it's interesting, and I don't think it's going to be quite as clear as what happened in .com, is I wonder if you might find the likes of Nvidia actually leaning into some of those smaller companies, because we've already seen Nvidia propping up some of the smaller companies with equity investments into them already, which kind of goes back to that circular deals I talked about at the beginning. But Nvidia has very strong market fundamentals. They have minimal leverage, and in all likelihood are going to be able to weather a correction. And so do we see them actually seeing this as a buying opportunity to be able to help some of the smaller companies with more equity investments, particularly if it benefits them from their business standpoint? And so I don't think it's quite so clear yet as to what will happen to some of the smaller players in a bubble situation. But going back to kind of the broader implications of this, in terms of the wider economy, look, you're going to have a big tightening of financial conditions in the case of a market sell-off. But I think really the most important impact of this is going to be the wealth effect, because when you look at the enormous returns that have happened in this sector over the past couple of years, that has made a lot of people feel very wealthy. While it might not be cash flow into their pocket, they look at their portfolios, their retirement accounts, and they think, wow, I'm wealthy. I can have more propensity to spend. And so you're going to have a real impact to the consumer if they see those portfolios take a large hit. And a lot of what has held up the US economy over the past few years is really that strong consumer. So if that falls away, which I think it would in this situation, you could end up in a shallow recession, with the risk that it actually escalates to a larger recession if it ends up resulting in broader credit concerns, which would lead to credit tightening. And we know what that looks like in terms of kind of when credit issues escalate, the impact it can have on the broader economy. So my expectation would be a shallow recession with that tail risk that it leads into a broader credit issue as well. So what this means from a portfolio perspective is, like what I said at the beginning, that FOMO could continue to drive this market higher in the near term. And actually, our own research internally has found that short-term returns aren't actually as impacted by valuations, because that momentum can continue and it's impossible to time when these things turn. And elevated valuations in themselves do not trigger market corrections, but they do make the market a lot more vulnerable to shocks. So I'd say you do want to stay invested, because you don't want to continue to miss out on this. And like I said earlier as well, like I think we're in the first innings of the investment here. And this could continue for a long time. But you do want to maintain dry powder. At least that's the way I'm looking at it anyway, that you want to be able to buy on any pullback or any strong reduction in the valuations. And you also want diversification. You want it across sectors, you want it across regions, because so far I'd say this has been very concentrated in technology in the US. And like I've said repeatedly, the broader economy and the broader world has a lot to benefit from AI. And so having that diversification means you're less likely to underperform as if you were solely focused in technology. But you also want some diversification across asset classes. And this is where I'm probably talking my own book a little bit here, but fixed income, other asset classes, just to give you that shock absorber to the equity market performance.
Fantastic. Well, something else I'm curious about is if there's anything that we can learn perhaps from previous historic bubbles, because of course there have been so many over the centuries, particularly after new technologies burst onto the scene and promised to transform the world. So is there anything that we could perhaps learn from some of these historic bubbles?
Yeah, I think it's really interesting to look at that. I mean, particularly at the dot-com one is the one that has had a lot of comparisons to this one, just because of the valuations in technology specifically. But I do think, and I think as I've said through this recording, is that like I do think there's enough differences that we're not in that same situation. But it's still interesting to look at what happened in that. And really what came out of the dot-com bubble was the internet. And I don't think anyone could imagine our lives without the internet now, and what that has enabled us to do from a productivity standpoint, and just everything from work to our personal lives as well. Similarly, with if we go even further back in history, you've got the railway bubbles of kind of the 18th century, where railways were critical to the Industrial Revolution, and more that's come following that too. Again, could not imagine our lives without railways, and they take everyone into the city every day in London, for example, to work. So I do think that historical bubbles do show to us what happens in the short term in terms of a correction is not going to detract from the long-term potential of this technology. And I think it was a really interesting and usable quote was said by Jamie Dimon a couple of weeks ago, where he said AI is real and it will pay off in total. And I do agree with that we are going to see value that's created here by all of this investment in building the AI. And that value, hopefully, that's created actually exceeds anything that ends up being lost in a potential bubble situation. And these investments in infrastructure will be put to good use. They are going to find a home in the longer run. And so even if there is a misallocation of capital in the shorter term, the longer term is still overwhelmingly positive. And I do think the previous bubbles show that to us.
Well, Rachel, that's been so insightful, a fantastic overview of all the issues. Now, just whilst we have you here, I hope you don't mind if I ask you a couple of different questions, perhaps about the role of AI in investment management. It'd be great to get your perspective on what you believe are the parts of the investment process that will be most transformed through AI going forward.
Yeah, so this part I think is super exciting because obviously I have a lot of personal advantage from this one because it really impacts us day to day, and really excited about what is coming here and what is already available to us too. And I think the most transformational area in my mind, at least right now, is when it comes to investment research and insights. So we already have Gen AI being able to distill complex documents into concise, actionable insights, which is enabling real time decision making. The other thing that then comes with that is you can actually expand your breadth of coverage. So, for example, overnight agents is a really interesting concept that we're exploring, and I know others are too, where it's almost like you have 24/7 research analysts. So you can have these agents that know what your portfolio holdings are. And while you're home sleeping at night or enjoying time with your family, they are researching, they're scouring the news, any developments that are coming, and they can flag the things that you need to be aware of when you come in the morning for your portfolio and changes you might need to make. So that is a huge expansion of your coverage. And the other thing in terms of expanding your coverage is they really do that you can actually use them also to produce fundamental reports for the names that aren't covered, whether it's by your internal analyst team, whether it's by kind of the brokers and what they cover from an analyst standpoint. So you can now expand coverage into those really less covered names, at least from a fundamental perspective, because you can have Gen AI write reports for you. And as a PM, you then absorb that and you can make a determination based on the valuations of whether that's worth investing in. So that's really, really powerful. I think the other thing is you can also enhance predictive insights. You can also enhance your ability to do scenario testing or stress testing in terms of just generating different scenarios. So investment research and insights is really where I think there's going to be the most transformation. And that's where I think about everything that's going on right now there.
And Rachel, where do you see the most impactful opportunities for AI in your portfolio management process?
Yeah, so on that side, I think it's really about the scalability. So it's about being able to manage more portfolios per person than you would have been able to previously. And some of this has been possible in the past with machine learning, which has been around for a long time. But I think the developments and enhancements that are coming in AI are only going to serve to enhance that. So if I think about, for example, a systematic process where you are able to actually encompass all factors that a portfolio manager would consider, but in a more scalable way. So you're creating models that are considering things like the relative value, the fundamentals, the technical picture in the markets, all these things that each day as a PM we are taking into account when we make our decisions. And you create models that you can then tie in directly into an optimization engine that then makes selections based off that, and can then, this is where AI comes in, I think, can eventually like learn from those selections over time and potentially bring some generative scenarios in too that we might not necessarily have thought of and built of ourselves as a PM, and then can only serve to enhance the way we select those portfolios over time. And so that's really going to allow you to manage more portfolios. The other thing that's really going to scale your ability to manage portfolios is co-pilot capabilities and agents. So right now, as a portfolio manager, you're having to look at your performance every day for every single fund, try and figure out what is driving that performance, then go and look at the funds themselves and the positioning and figure out what you need to do from a risk perspective. But if you could have co-pilot agents that are able to tell you first thing in the morning, you have this performance in this fund and it's driven by this positioning, which is actually not in line with how you want to be positioned or what your targets are. And then it is able to then recommend actions you need to take to amend that. that would save a huge amount of time from a portfolio construction, portfolio management standpoint. So I feel very excited as well about the Copilot capabilities, where it's not necessarily going to add value per se, but it's just going to make it so much more efficient to understand where your risk is at and how you might want to change that and actions you might want to take.
Wow. So amazing opportunities there up for grabs. So
Yeah.
what would you say to investment leaders? How should they go about trying to seize these opportunities now?
Yeah, and that is really important because look, a tiny advantage in anything when it comes to investing can really impact your returns meaningfully and particularly when you then compound that over time, that can become really large. And so on the flip side, a tiny disadvantage can also do the same thing on the downside. And I think if you aren't involved in AI and are not exploring this, then you really are at risk of putting yourself at a disadvantage. And it might not even be small with how quickly these capabilities are running. And for us at Vanguard, technology is central to our mission. And it really helps us uncover and create and deliver new ways to drive positive outcomes for our clients. And so I feel very passionately about this and about the fact that investment leaders really need to be doing a lot to make sure that their investment teams are doing everything they can to incorporate AI. And so the advice that I would give that I'm thinking about myself is, how do you instill that culture where your investment professionals are looking to upskill and adapt and learn so that they are able to experiment with these tools and these new technologies, and that's going to lead to greater productivity. And I think it's really important that you don't wait for these tools to be the perfect complete package, because we are still in learning mode with AI. But the more you explore and experiment with them, the more you're going to build your own understanding of what they can offer and the value they can add, but also what their limitations are and what not to be kind of spending a ton of time on. And so it really comes down to encouraging that experimentation and exploration and not being scared of it because we don't necessarily have the final technology products yet. And I think it's really important that leaders champion the successful use cases. So if you have been using Copilot capabilities or you have been using generative AI to distill research reports, make sure you showcase that and your employees know it and they can see it, because then that gives them the context to think through what they could be doing. And I think ultimately, as a leader, at the very highest levels, you have to value AI fluency, because that is our future. And wherever this goes from a bubble or not bubble perspective or correction and valuations perspective, as I've said throughout, AI is here to transform what we do. And that is also the case in the investment process. And so you, future leaders need to be fluent in AI as well as investments.
And I couldn't think of a better call to action to end on. So, Rachel, thank you so much. That's been a wonderful conversation, absolutely jam packed with insights. Really appreciate your time. And thank you, everybody, for listening. Please do join us again for the next episode. Thank you.
Thank you.